How to value your real estate assets. Property valuation, or appraisal, of your real estate assets is a key aspect of property investment. It's important in the purchase and resale of a property, but also for insurance and financing purposes for the time you own the property. Understanding the valuation process allows you to assess and place an appropriate value on your property. Cost approach. This is based on the concept of objective value, also known as the cost to create. Cost approach is particularly useful when the subject property has been extensively renovated or newly constructed. The main stages of the cost approach to value are: estimation. Estimation of the value of the site and its reproduction cost, sometimes mistakenly called replacement value. In some cases, replacement value is the only accurate figure you can use, along with an estimate of the accrued depreciation associated with structures on the property. Adjustment. Adjustment of the property's value is determined by subtracting the estimate of accrued depreciation from the estimate of the reproduction cost, or replacement value, when applicable. Market value estimate. Market value estimate is calculated by taking the adjustment figure from the step above, and adding the estimate of the value of the site. Sales comparison approach. The sales comparison approach is perhaps the most common method of determining the value of real property. The estimation of the property value is based on recent sales data for direct comparables sold in the area in the past 6 to 12 months. Real estate agents often use this approach in larger markets where there are a number of similar properties, as this valuation method accurately represents the market value of the property. Income approach. This is commonly used to determine the value of an income-producing property, where there is a relationship between the income a property is capable of producing, and the value of the property. The main steps in calculating the value of a property using the income approach are: estimation of potential annual gross income. Using a motel as an example, the potential annual gross income is the dollar value that could be realized if every room was fully rented at the highest rate every night for the entire year. A vacancy and bad debt allowance, based on current market conditions, is subtracted from this figure, which becomes the effective gross income. Estimation of annual operating expenses. This is a figure that is often determined by calculating the operating expenses applicable to the majority of similar property types in the same marketplace. This includes industry standard expenses, such as telephone, internet and cable services, as well as fees for regular utility and seasonal maintenance. The annual operating expenses are deducted from the effective gross income to provide an estimate of net operating income. Capitalization rates are determined when the valuator converts the income of a property into an estimation of the future cash flow compared to the return on the initial investment. These ratios are usually expressed as a percentage of the expected return on your initial investment. Thanks for listening. Find more tips and training on our YouTube channel at bettergrouprealestate.com.